Welcome back. The next T in our second T is technical setup. These are patterns in price action that can indicate potential areas of entering positions that decrease the risk and give you a high probable area for it to go in your direction. So first thing we're going to talk about is continuation patterns. And what continuation patterns is basically looks very similar to this, where the market has gone up, it is pulled back, and then some type of a retracement. In this case, we're saying a 50% retracement of this move. And then you can see our first entry on the pullback as it starts to pivot back higher. That would be a secondary trade. And then once it broke out above the previous high, that can also be a possible trade. So there could be 2 or 3 options. And again, when we start talking about triggers, we're going to talk more specifically about that. But that's going to be one of the technical setups. Here's going to be an additional technical setup. Normally, this is when we're seeing price having broken down and starting to move higher. We're starting to see accelerated momentum to the upside. So that second move, we're seeing an increase of momentum. That tends to be a stronger impulse than our previous impulse. So just something to consider. And then slowing momentum is after you've already had a major push higher. You'll see a little bit of a pullback, and then it will go up, but it won't go up as high. That could basically be the same basic continuation of those patterns, but there are 3 different strengths of that. So just something to be aware of when we're looking at this stuff. Same thing to the downside. You can see both of those legs kind of have equal momentum, and then you can see where your first entry would be as it had gone down, it had retraced up and go lower. And we'll do some live examples, some additional videos just to kind of explain these particular trades. This one again is an accelerated momentum drop where you could start to see additional price action with dropping, and then a slowing of momentum to the downside. Now, the next part to this is going to be more of what we look for reversal patterns. Now, we have to remember what a trend is by definition and how to identify areas where the market may be curling over and going lower. So we'll basically look at this. You can see how the first drop, you have a lower, it would be coming off of a lower high. See, it comes up and puts in a lower high, then it puts in a lower low as well as a lower high, and then puts in a higher low, and then puts in a higher high. So that's the anatomy of remember trends. It's peaks and valley correlations. So you can see lower highs, lower lows, and then you see a higher low, and then putting in a higher high. And that is a great trade for looking for bottoms, very low risk entry. And on intraday time frames, you tend to see these quite a bit. So normally you'll get a few trades a day. This is a very similar setup to that one. Again, lower highs, lower low, rallies up and automatically breaks above that high. And normally for beginners, you'd be taking that third entry or possibly the second entry once you know that it puts in. Because remember, by definition, a trend is higher highs, higher lows. So the second we start breaking above this high, that's an indication that we could see this to put in a higher low and then go higher. So that's another great little trade for us there. Same basic parameter here. Again, what we look for is the same correlation. Some people may refer to this as a head and shoulders pattern, but again, similar pattern. You've got your low, higher low, lower high, higher low over here on the right at the second entry, and then it puts in a higher high. That can be an additional trade, and we've got some examples of that we'll show you in a little bit. Same thing to the downside. You have a push to the upside, higher low, it puts in a higher high, starts to sell off back below that, and then puts in a lower high and then a lower low, and you can see where it actually breaks below the neckline there. So similar analogy, again, same basic structure. And when we talk about market structures, that's one of the things we look at, and you'll see that they're all basically variations of each other. So whenever we're taking trades, we're always comparing peaks and valleys and those relationships to each other when we're talking and looking at particular potential trades in the market. So just keep that in mind as we're going through that process.